You're listening to the Rite Retirement Show.
The 70% of people out there listening to the show today are going to need some level of care. It doesn't necessarily mean that 70% are going to end up in a nursing home, but 70% of people will need some assistance out there. The biggest fear is running out of money for the retiree, but what we see is not enough people spend enough of their money.
Cris prides himself in what matters to you. This is the Rite Retirement Show.
Hi there. Welcome to our show. I'm Luann Fulmer, joined by two WG financial advisors, Cris Wallace and Graham Bauer. They're going to share their wisdom and how you can live your best life in retirement. Cris is president at WG Financial Group. Both Cris and Graham are certified financial planners, and we do not want you to wait to call, okay? During our show, you can call or text the word VISIT 256-937-2010. You can get this complimentary discovery session that you'll hear Cris talk about. You can always stay connected with us on our website, wgfinancialgroup.com, or even on Facebook. Just search for the name of the company and find us on your favorite podcast, wherever you get that, Spotify, Apple, even YouTube. All right, we're going to talk now about how we can plan, retire, and play. Hello to you both, Cris and Graham.
Luann, hello to you as well. It is so good to be back. It is so good. We
Thank
had some
you.
radio equipment problems,
Yes.
and we had some internet problems, and we've just been doing nothing but reruns, but we are back. We're like Florida Georgia line. We're back.
We're back. Yes.
And Cris has a soundboard now.
Cris
And I
has
have
a
a new toy. Yes,
So pre-apologies to
Yes,
everyone
right.
listening today.
absolutely.
Graham and
yeah.
I, not in control. Cris is in control
No,
of the
I've
board.
got the soundboard.
We're
Yeah.
at your mercy.
Yes, we
Yes.
are. But
Everyone
it will be
is.
fun.
Oh, I have a monster voice on
Yeah,
here.
do
I guess I
that.
could do that. Yeah. So, all right. Well, yeah, we're back. I'm glad to be back, actually, because I've had a
Yeah.
couple people say, it's just reruns. I was like, yeah, I'm
Well,
sorry. We've had some equipment
yeah.
issues and some internet issues. My son's worked pretty hard on getting the internet side of things kind of fixed up here. And the soundboard, we had to get it up and running today, but we are ready
You
to
had to
rock
get a
and
brand
roll.
new soundboard, didn't you?
We did. Yeah, it's
Yeah.
nice, as you heard.
Yeah.
Yeah, it's nice. Really, really nice.
Yeah.
So,
So
this
happy to
week-
be back with you guys.
yeah.
All right. So what do we have? Because normally we do a couple things here at the beginning of the show. Let's see here. No market update, but we were going to talk a little bit about SpaceX, though.
Yeah. So let's just kind of talk a little bit about SpaceX. It IPO'd last week, and it really, really took off. And at one point, I think it got up to, I think it was around $213 a share or somewhere close to that,
Wow.
211, something like that. And then it just kind of rifled back down, and it's trading at near where it kind of IPO'd at, essentially. And one of the things that I just wanted to mention, because we've got a lot of questions from people in general, our internal client base, where they're asking about it and how can we get in. And I mean, this IPO was historic in the size of it, but just the way that people wanted to kind of get in. And normally you kind of shy away from IPOs. I mean, if you're one of the seed investors early on, that's kind of, unique because you can really, multiply your wealth there, but you got to have a lot of money to get in and do that. But at IPO, usually a lot of times people just kind of sit back a little bit before they buy. But man, just so many people wanted to buy shares of SpaceX. And like I said, it took off, and then it's kind of plummeted back down. And I don't think, Graham, I don't know how you feel, but I don't think especially when it's trading at like 211, I don't think the stock price warranted being that high based on just the revenue that the company generates.
Yeah, I mean, obviously, a lot of the hype around it just has to do with it being, an Elon Musk company, and obviously a company that is dominating in the space exploration, space development industry, especially for folks in the northern Alabama area where there's like a huge amount of people who have worked with NASA and worked in space research. I think that it was a big deal for that reason, but I can't remember ever seeing this much hype around an IPO. I think the thing that I was trying to remind people of is not that, I mean, I'm not going to sit here and say that SpaceX is a good buy or a bad buy. It could go either way at this point. But what I do think is something to consider is it similar to like if you're buying a house today at today's housing prices. I'm not saying you're getting a bad deal on a house if you buy a house today, but you shouldn't expect that housing price to double in the next 3 years because houses have gone up a lot in the last few years and they're
Mhm.
very, very expensive already. And the idea of them doubling from their current price would be fairly unlikely in a short amount of time. In a long amount of time, sure. But in 3 years, I would think that would be very unlikely. I think kind of felt the same way about SpaceX, where even if there is growth potential there, you're not talking about NVIDIA 10x growth potential. It would make it by far the most valuable company in the world. And I saw a comparison the other day that their revenues currently are a little bit less than Carnival Cruise Line. And
Wow.
today they're valued, or at the peak, they were valued higher than Microsoft.
Yeah.
And so, again, I'm not saying that they can't grow to that level, they can't get to that level, that they're not a cool company, but it was very surprising to see the amount of people who I think more felt like they were missing out on the opportunity of a lifetime by not getting in.
Yeah, FOMO for sure.
Yeah.
I mean,
Mhm.
that's the way it felt for me. I know internally we have a couple other advisors at the office, and they were getting questions as well. And it really is FOMO. And just sit back and watch for a little bit. Let some of the hype wear off, and let some of the steam and air come out of the balloon, so to speak, and then kind of take another look at it. So I don't know. I'm not ready to say it's the greatest buy ever. Will it be in a portfolio or my personal one later on? I mean, I don't know at this point. I'm just going to continue to watch, and I can tell
Mhm.
you what I'm not going to do personally is I'm not going to get in while things are kind of bouncing around like crazy
Ah.
because I don't want to be tempted to look at that. But I do agree with the company itself and some of the things that they're doing and trying to do in the future. And keep in mind, some of the things that they've talked about is still yet to be proven. So, just I guess the message in talking about this is just be patient with something like that. Don't let all of the euphoria and the hype, it also, we'll hush in a minute about this, but it reminded me also of like Bitcoin as well,
Mhm.
crypto.
Yeah.
It's like, oh my gosh, I got to get in crypto and all of that. And I think that is where the FOMO stems from. Now that I'm kind of piecing
Mhm.
this together as we're talking, literally talking it through because we didn't talk about this pre-show, but the Nvidia, I think people feel like they missed out on Nvidia. And if you look at Nvidia and you kind of put it next to Bitcoin, Nvidia's outperformed Bitcoin over the last 15 years or so. So maybe you didn't invest in Nvidia earlier. So you missed out kind of thing. Maybe you didn't get in Bitcoin or crypto early enough. Oh, you missed out kind of thing. And now there's SpaceX.
Mm.
And people are like, oh my gosh, is that the next NVIDIA? Is that the next SpaceX? Or I'm sorry, the next Bitcoin, so let's get in SpaceX because we definitely don't want to miss out. And we want to get in on the ground floor when things are cheaper. And I think that's probably what's going on is we've had some really good, positions or, stocks do well and people just don't want to miss out.
Yeah, I think a key difference to remember if you're someone that feels that way is 10 years ago, was everyone and their mother trying to buy NVIDIA stock? No.
No.
I mean, some people may have had some early ideas that would really take off. But a lot of times when you have something, have the kind of growth that a company like that has, when you talk about the 10 times growth kind of thing, it's smaller companies that are starting off a little more unknown, a little more in the background. And then by the time everybody knows about it, it's not that it can't grow. It's just probably you're not gonna turn $1,000 into $1 million like maybe you could have if you were the first person to hear about it. And you hear the stories now of some of the SpaceX employees that have been long-term employees. Yeah, I mean, they've obviously done fantastic on it, but
Yeah.
they've been getting stock for a very, very long time before the public could and all those types of things. So again,
We're
it's
in the wrong job. It made me realize we're in
I
the
know I
wrong
should have
job.
been a lunch lady for
Yeah,
SpaceX,
right? Yeah, lunch lady.
apparently.
Yeah.
It's one of those things though where I don't want to, because we've gotten so many questions about it, that I don't want to be down on it and tell people it's a bad investment. Don't put your money in it at all, because that's not really what I believe ultimately. But I don't believe that if you don't put money in tomorrow, you're missing out on the growth opportunity of a lifetime. I think there will be other opportunities, just like there are with any position. I mean, and even great companies, prices move up and down, and there are times that are better to buy than others. But right now, we're kind of going through that price discovery phase where the market hasn't really decided what the price is. It's going to be all over the place for a little while, just like with any IPO. So I think it's just just remember, like we've been telling everybody, that if you're going to put some money in something like that, you just got to understand that at this stage, there is a level of gambling to it, of you don't really know exactly what's going to happen in the short term. And you have to be okay taking on that risk. And if you are, then maybe it's okay to put some money in it. And if you're not, then maybe steer clear of, slightly more speculative things like that.
Yeah, use caution, seek advice is the message.
Exactly.
You guys, I got to tell you something funny though. It's right on this topic. So when it was getting ready to go public, I wanted to get in on it beforehand. And so I was like telling, my son-in-law, we want to get it. Of course, he's overseas. Okay. But he helps us with stuff like this. And I'm like, okay, we want to invest in SpaceX. And he's like, that'll be $100,000. I'm like, oh, never mind. So I was thinking
and typically
$1,000, right? Yeah.
And that's been a big difference too. Typically, there are very large limits on minimums, I should say, on what you can invest in IPOs, and they really lowered that for this one. So,
Goodness
but
sakes, yeah.
yeah, it is. It's been wild though. I mean, just as far as public perception, and I mean, I don't know, Chris. Obviously, you've been doing this longer than me. I've never gotten more questions. This has surpassed even Nvidia a few years ago as the
100%.
most
Yeah.
questions I've ever gotten about a single stock.
Wow. Yeah. So funny. Okay, well, let's move on then. And anything with a federal minute, Graham? I thought you had something.
Yeah, one thing I just wanted to mention here. We were doing one of our classes on federal benefits a few days ago. And one thing that was brought up that it's just a good thing for people, federal employees, to check on if you haven't, has to do with your FEGLI, so your federal life insurance, your federal group life insurance. So an interesting thing about FEGLI is obviously you have multiple different parts of it. You got your basic, you got your A, B, and C. And C specifically is where you can get some insurance for kids, for a spouse. But what some people forget to do is over time, kids graduate and they age out of the program. And sometimes people get divorced or they get widowed. And there is no way for the government to know that unless you specifically drop that benefit. So we have seen before that there are people out there who maybe were married at one point and had two kids, but now they're maybe divorced and the kids are 30 years old and they're still paying for this part, which isn't horribly expensive, but it could still be some money that you're paying for, and it's not actually covering anybody. So it's just something to check on, and not even just for FEGLI C specifically, just in general, when you're talking about your federal life insurance. I really say this more as a reminder that the government isn't really looking out for you with that life insurance. You kind of have to look out for yourself of what benefits do I have? When are these price increases coming? How much do I actually need? And it's just something you should review periodically, because that's just one of the many mistakes we've seen. But I just wanted to bring that up in case there's somebody out there who is thinking, oh, me and my wife split up a couple of years ago. Maybe I should check if I'm still covering her with this insurance.
That's so true. Yeah, that's kind of, that would not be good. Well, you guys, were coming up on our 250th birthday celebration for our country. Pretty
Yes,
excited
we
about
are.
it. Are you guys? I think it's pretty cool.
It is
Yeah.
cool. Yeah, it is cool.
Every time I see, so there's all this paraphernalia that has the 1776 through
Yeah.
2026.
Uh-huh.
And I just can't help but always think it looks like a gravestone when they say that, like America also dies this year.
Oh, please, no.
I feel like they should say 1776 through current or something, through ongoing.
I
Because
see
when
what
I
you're
just see
saying.
that, it feels like an end date.
That's hilarious. But no, it's not an
If
end
you
date.
look at
no.
the debt, I think the writing's on the tombstone.
Yeah, right? Yeah, that's
Maybe they
true.
should just put 1776. Much
Yeah,
cooler.
since
now, but-
1776 or something. I've just we were
yeah.
at Walmart the other day and they had those plates and cups. I've seen it a few different places. It just makes me chuckle every single time. I don't know.
I don't see it that way because you know what? I lived through the bicentennial, the 200 year. I was in high school. We were selling cups, to people.
Oh, yeah.
Yeah.
I remember.
1776 to 1976. So, I've kind of done that. And so,
That's when my brother was born.
is it?
76.
Oh, yeah. But anyway, Graham, I get what you're saying. I do get what you're saying. But at 250 years, that's pretty cool. Hey, we're going to go to Washington, D.C. this fall. I thought this would be a good time to go in the middle of our 250th year.
Don't mess around in that reflection pool. You get arrested.
God, man. I'm like, please, people. Oh,
I'll stop with my snarky
my
comments today.
gosh, right. I know. We're going to go visit it.
That's
And
gonna
we're
be
going to,
fun though.
yeah,
I've wanted to go to
yeah.
DC. We haven't made it out there yet,
I
but
dare
Mhm.
you to jump in the
oh
reflection
my
pool.
gosh.
No. I just think it's wonderful. And I figured let's go now while it's all beautiful and safe as far as we know. So,
Yeah.
but anyway, we're talking about, how our country's 250 years old and we have, independence from Great Britain. But I want to talk about financial independence in your life right now. And of course, we always talk about retirees or people who are approaching retirement. That whole phrase of financial independence, is more than just the day that you stop working, right? It's the day you stop guessing, stop reacting, stop worrying about whether or not your money's going to hold out. And, we want you to plan, retire, and, live in retirement. We want you to be excited about it. So I want to talk about how we can find true financial independence and why so many people with serious savings still feel so uncertain heading into retirement.
Yeah. Well, complete financial independence is basically doing whatever you want, whenever you want, with whoever you want. And that's the way, I want to feel when I get to retirement. I want to be able to do whatever I want, whenever I want, and with whomever I want. And when you achieve that status mentally and psychologically, then I think you've reached financial independence. But I think it is and we've talked about this a lot of times on the show, there is a big transition from I think I'm good enough to retire to getting in that mindset of I know I have enough. I have a plan in place. I know what's going to happen with my health care. I know about my tax picture. I know how, where I need to be in terms of Medicare premiums and IRMA and all of that. It just takes a while to get to that point. We call that just the retirement rhythm. When you reach that point, now you're in that retirement rhythm. Now you've mentally achieved that financial independence because psychologically, there's still going to be some doubt when you go into retirement. And I think there's something to be said for even people with like large portfolios. They still get anxious. They
Mhm.
do. I mean, I have clients that they have plenty of money and they still get anxious when the market gets a little bit volatile. And I also think that accumulating your dollars for retirement is drastically different in a couple of ways here than pulling income out of the portfolio. So, number one, you're pulling, not pushing. And number two, you've been taught to push money in and save, and now all of a sudden you're pulling it out. So it's a different feeling. So there's some different skill sets required there, both mathematically and then also just psychologically as well. And most people really plan to retire, but they don't really plan for retirement itself. Like we know when the date is when we're going to retire. One of the things we don't know in retirement is we don't know our date of death. Like we don't know when God's going to call us home. And then most people don't really think about what are some of the things that they're going to be doing in retirement. And we do try to coach people. Like I was meeting with a single female last week, and one of the things that she told me is she's not sure what she's going to do in retirement, and she's getting ready to retire at the end of the year. And I said, okay, at the end of our second meeting, I said, as you contemplate whether or not, you're going to join our firm and work with us, what I want you to be thinking of, whether you work with us or not, is I want you to be thinking about what you're going to do on a day to day, week to week, month to month basis in retirement. Think about the things that you want to do. Think about the amount of time and money it's going to take, and then think about who you want to do those activities with. Because I think that there's a lot of validity in thinking about that. Like I think it's something that I feel like every pre-retiree should do is think about and envision what their retirement looks like. You have to be able to see that kind of stuff. Like you saw yourself getting to a certain number in retirement in terms of your savings. You saw yourself retiring and turning in your federal paperwork or your notice if you're working in the private sector. Now you need to see yourself actually living out retirement. And you need to be able to see that before you get there so that you can kind of start building that plan to allow you to do those things. Because most people that listen to the show and come into the office, they have plenty of money to be able to do that. They don't know how to envision it. They don't know how to build the income plan, pull out of their portfolios in a tax efficient manner. And that's kind of where we come into play and we kind of help with that.
Yeah. And one thing you mentioned, Chris, I just wanted to touch on a little bit more. I do think it is a huge misconception among some people that just getting to your, retirement number, if you have that number, will relieve your anxiety about it. And I've that could not be further from the truth, to be honest with you. I know there are some folks out there that they'll think, once I get to 500 or 750 or a million or whatever that number is for you, like I'll feel good about that. I'll feel secure. I'll feel like I can go out and I can do what I want to do in retirement. I can live life to the fullest and I won't have to worry about money. I have met very, very few people who have gotten to that point and they don't still worry about money. Now, maybe when they're working, they're not worried about the day to day of life while working with a nice 401k or Roth or whatever. But once you turn that income faucet off and now you're retired and you just got that money to live on and you got to start drawing from it, it's really, really hard to do. And so, I completely agree, Chris, that you got to have a plan of what you want to do in retirement
Hmm.
so that you can make sure that you're also not just sitting around all day worrying about retirement because I mean as you know we've
That's
sat down with so many people who are
that's
just
no fun.
yeah.
Like if you're going to sit around all day and just worry,
Hmm.
well, you might as well work and
Yeah,
worry. At least you're getting
exactly.
paid to worry.
Yeah,
Yeah.
yeah,
Yeah. So I mean, like
yeah,
I never understood like if you're gonna retire and all you're gonna do is sit around and check your accounts and worry all the time, well, you might as well just work.
yeah.
And at least your boss will worry you, and at least the boss is paying you for
You're getting
worrying you.
paid to
So
worry. Yeah.
yeah, I don't understand that. I because it's just so I've done this enough now, Graham. As you know, I'm oldest guy at the office and got more gray hair now and been doing this for 20 plus years. And I've seen people retire and just not be able to really retire.
Mm.
And because I've seen that so many times, that's just embedded in my mind is like, I don't want to be that person. Like, I've made a change financially speaking in my own life and how I save money and invest money versus the way that my parents did it. I made that change because it was really better for my family. And now I've seen all of these, I will say all because it's not, but I've seen several retirees throughout the year who can't retire. They can't give themselves mental permission to enjoy their retirement. And that is not who I want to be. Somebody asked me the other day, they said, I can't really get over the fact of paying someone to manage my money. And I was like, well, guess what? And he's like, what? I said, I have my money professionally managed
Mhm.
because I don't want to worry about it. And guess what else? And he's like, what else? I said, I pay a CPA every year to work with me. I'm heavily involved in my tax picture. And I said, I also pay an estate attorney to work with me and my family. And I also pay a business mentor to make sure that I'm expanding at the proper pace and hiring the right people and to help me work on culture and things at the office to make sure that we provide not only excellent service to our clients, but also a great cultural place for my employees to work as well. And I pay all those people. And I'm okay with that because what they do is they keep Cris Wallace walking in the right direction. And they allow me to focus on other important areas of my life. And it's worth it to pay them in their skilled profession so that I can spend time with my wife and my kids because I've seen way too many people like you, Graham, pass away way too early. You've seen the saying on social media, gone too early when
Mhm.
somebody passes away. I've seen
Right.
that.
Mhm.
And I've seen people just pass away early. And I am going to make sure that every opportunity I have to spend time primarily with my family and or friends, I'm going to do that because you never know when that's going to be your last shot to do those things. So I'm willing to have a team of people surround me and help me go in the right direction. And I'm willing to pay for that personally. So,
Yeah, it's just like anything in life. I mean the analogy I always go back to and it's simple but it's just the personal trainer analogy that there are so many personal trainers out there and there's a lot of people that pay for personal trainers and there's a lot of people that don't and probably should because they'd probably
Yeah.
be in better hey I probably maybe should sometimes it's because at the end of the day we can all know what we're supposed to do and know what the right things are to do
Mhm.
or do some research online and have some AI software build us some regimen but if we don't do anything about it, if we don't have any accountability, anybody that we can ask questions to, a trusted person to make sure we're going in the right direction, a lot of people just lose steam, they lose focus, they lose motivation. And I don't know. At the last stage of my life, and I'm get to retirement, I don't want to think about my accounts at all,
No.
to be honest. I mean, especially, I guess, especially with my work. But I don't want to sit around thinking about what the market's doing, or if I need to rebalance things, or if I need to buy into the new IPO coming out. I don't want to worry about any of that stuff.
Yeah.
I want to be worried about spending time with family, making memories, giving back to community, whatever that brings me life and joy.
Mhm.
Because there's nothing to your point of people who have passed away early. There's nothing that takes someone out of the earth quicker than just losing purpose and losing joy.
Oh,
I mean,
yeah.
Oh.
if you've lost purpose in your life, and
Mhm.
you
Yeah.
don't make an effort to find that purpose and find joy and find community, you're cutting your life short just right there.
Yeah, you're talking about the personal trainer. I see that like almost like a financial plan. So I know you've talked to people. I'm assuming you have. I say I know. I don't know for sure, but I know personally that I have spoken to people. They say, "Oh yeah, I work with a personal trainer." Here's the deal: like when you're training, especially lifting, you cannot outwork a bad diet, and I'm like living proof of that. I'm like Calvin Klein model fat.
Oh,
So
stop.
uh,
What?
I'm in the gym and I want to be the Calvin Klein model, but I got a fat suit on, and it's just the way it is. Why? Because I love chocolate and I love hamburgers and I love French fries, and you have to put the work in. And I see, when you work with a personal trainer, it it takes the training aspect. It also takes the dietary aspect and the discipline. And even though a personal trainer and you're working out with a personal trainer, you may be missing certain elements of the full training that you really need to take your body and mind to the next level. And sometimes that can be a lot like financial planning. It's like, okay, I saved enough money for retirement, but I don't know how to pull it out in a tax efficient manner. So I'm missing that nutritional piece of my retirement plan because I don't understand the taxes on the funds that I have. And, I'm not doing things as efficiently as I could. And therefore, now I'm not able to implement. I may know, like you said, to your point, Graham, there's so many resources available today where, you can Google this or go to AI and check this. But if you do not implement things, then it's not going to work. And I think you just mentioned, like, for example, you may have AI or Google build this big, nice outlay for you. But if you don't go implement those things, that's kind of like working out with a personal trainer. If you don't do what the personal trainer says the days that you're not with the personal trainer or you're not eating, you're not implementing, you're not going to make any ground or make it to your goals that you're trying to do. And I think that retirement planning is very, very, very similar. There's a lot of information out there where I think people, if they spent time and spent enough time long enough and hard enough, they could spend part of their retirement kind of figuring out, I would say, I don't want to say most, but at least some of their retirement. But it takes a lot of effort. And you're like, oh, I read this. Well, did you read it and take action? And I think taking action is the part that's missing. And that's why when people say, oh, well, AI is going to replace you. No, it's not. Because you may read something, but if you do not take action and implement it, then you just read it. You still are in the same spot because you didn't take action. So anyway, I don't want to feel like I'm rambling because I feel like I am. But anyway, this is the first half of the show. If you're catching this show on the way to church, you're catching the 30-minute version. You can hop out to Apple Podcast or Spotify platforms and catch the whole show. And you can also set up a discovery session with us by calling 256-937-2010. Again, our number is 256-937-2010. Thank you for listening.
Would you rather pay more or less in taxes? If you want to pay more, don't do anything. If you want to pay less, talk to Cris Wallace to see what's possible for you. Just text VISIT to 256-937-2010. Again, text VISIT to 256-937-2010.
Are you a federal employee feeling pressure from the early retirement offers like VERA, VSIP, or the Deferred Resignation Program? Recent government initiatives have introduced significant changes to federal retirement programs, making employees feel pressured to consider early retirement or face potential layoffs. At WG Financial Group, we help guide federal employees through these uncertain times. Our team understands the complex federal retirement systems and can help you make informed decisions. Call 256-937-2010 to schedule your complimentary discovery session with us today. We'll help you assess your options and create a personalized retirement plan to help you feel more confident. Visit WGFinancialGroup.com or call 256-937-2010 to book your session. Firm is not affiliated with the U.S. government. Investment advisory services offered through AE Wealth Management, LLC, an SEC registered investment advisor.
Dreaming up your ideal retirement? It starts with a solid plan tailored to your unique goals. Set aside uncertainty by arranging a friendly, informative session with Cris Wallace. Just text VISIT to 256-937-2010. That's text VISIT to 256-937-2010. Begin charting your course with confidence.
Yeah, so happy to have you with us. This is the Rite Retirement Show. I'm Lou Ann Fulmer, here with Cris Wallace and Graham Bauer, both certified financial planners at WG Financial Group, where Cris is president. And we're declaring our financial independence, as we're coming close to our 250th birthday on July 4th. So excited about it. But so talking about financial independence in retirement, I want to look at that first principle, and that is the idea, and you guys always talk about this, the idea that retirement needs to be designed, not just drifted into. Don't just retire and then there you are. So tell us what it actually means to design a retirement before it actually arrives.
Yeah, that is one of the most important things. And most people, I would say, want to have some idea of what it's going to look like before they retire. It's very seldom that you meet somebody who just like, yeah, I just kind of retired and I'm just kind of figuring it out. I don't know. I didn't really look at any of the numbers or anything. I'm just kind of figuring it out as I go. But I think that for most people, what it really looks like is ideally, a couple of years before you actually retire, not the day you retire, you're looking at all the numbers and you're just kind of knowing what your numbers are. And not just, how much do I have saved? Not just how much guaranteed income am I going to have? Not even just, what my expenses are, but how all of that interacts together. Because a lot of times it looks different than what people are expecting, either in a good way or sometimes in a bad way. But in our case, when we talk to a lot of folks, our kind of general client, usually more in a good way, mostly from the perspective of a lot of people will think, okay, well, I'm going to retire and my job income is going to go away and I'm just going to feel like I'm living on so much less than I am today because I make $200,000 a year today and I'm not going to bring in $200,000 in retirement. It's like, yeah, okay, well, you make $200,000 today, but that's before taxes, that's before you max out your 401k, that's before your more expensive employer health insurance, before the extra life insurance you're carrying, any other deductions that come in. And when you actually look at it, maybe it's a little bit closer to what you'll bring in retirement than you actually think, or maybe you'll even kind of break even. Or some people might think, oh, I'm going to retire and, my taxes are going to go up or stay the same, or they're going to drop. And they might be surprised that really any of those could be true depending on your situation. They do tend to drop for most people, but that's not a one size fits all either. So I think that for us, what we're really trying to do when we're talking about designing a retirement instead of drifting into a retirement is knowing all of those numbers and knowing day one when you retire, when you hand in that paperwork and you're done, you already know, I know where my first paycheck, quote unquote, retirement paycheck is going to come from. I know which account it's going to come from. I know how that's going to affect my taxes this year. And I know how my income for the rest of the year is going to get to me. And I also know that if I need to pull a little extra money for something else, something comes up, I know how I'm going to do that as well. And I think that just gives people so much more confidence when they can retire and just day one know what that's going to look like. And they don't have to wonder, okay, now I got to go figure all of this out now. It really just comes down to trying to recreate some of that structure that you had in your life before, because a lot of things change in retirement. I mean, from just a social aspect of work to purpose aspect of work to even just adjusting to the fact that your family knows you have more free time on your hands and now you might be babysitting all the time and things like that. There's a lot of changes.
We hear that a lot.
Oh, we hear that a
Yeah.
ton. I mean,
Mhm.
there's a lot of things that change fast in your relationships and your social life, all of those types of things. And so the one thing that you have a little bit more control of ahead of time is what your finances are going to look like and
Yeah.
how much that's going to change. Because we can't prepare you for how it's going to feel to retire and not go to work every day. We can't prepare you for that exactly. That is going to affect everybody differently. But what we can prepare you for is what kind of income you're going to have in retirement, where that's going to be coming from, what your lifestyle, financially speaking, can look like. And then from there, you can really build in the life that you want to live. So I think, again, just designing, not drifting is super important, because once you're retired and it's done, I mean, you can't plan for retirement after you've retired. Now you can manage retirement from then and
Yeah.
you can improve things still. So if you're already retired, it's not like you can't improve things, but you can't plan for an upcoming retirement at that point. So, getting to it ahead of time, really knowing what that's going to look like and building that confidence, I think is super important.
And I think there are people that, we talk about drift into retirement. When I think about the word drifting or the phrase drifting into retirement, what I think about is the person who has been an excellent saver all of their life. They've just kind of kept their head down, they've worked hard, they max their 401k plans out or their TSP, and they just get to retirement and they retire. They have enough, but they haven't done any type of actual planning for retirement, which means maybe for the last 10 years, they should have maybe taken a look at putting some into the Roth side of the 401k, or maybe 10 or 12 years before retirement, they should have taken a look at an HSA. And maybe they should have done that. So they start creating some money in a healthcare bucket. Or maybe they should have taken a look at what some of that extra income that went into savings. Maybe they should have made an outside Roth IRA contribution, or maybe they should have set up a TOD or joints with rights of survivorship account and put some additional money in there to kind of help bridge them if they didn't want to collect Social Security, or to give them just another, one or two tax buckets to be able to pull from. Those are the type things that, as you just said, Graham, once you get to retirement, you can't really plan for retirement. You can only manage retirement at that point. So drifting into retirement versus planning is, while you're working, you still have that ability to do Roth IRA contributions. You still have the ability to determine whether or not a certain amount goes into pre-tax, or a certain amount goes into Roth 401k. You also, when you're retired, you're probably not going to be actively investing in a TOD or a joint with rights of survivorship account. So I think knowing those things ahead of time, going, okay, these are actual better alternatives for me as I approach retirement, it'll make my retirement be more efficient, because to your point, once you get there, you got what you got. And that's it. If you got all pre-tax, well, good luck. I mean, you're going to be taxed on most everything that comes out of there. And the best you're going to be able to do is look at Roth conversions, where if you just started the thought process 7, 8, 9, maybe 10 years prior and thought about some short term and long term tax efficient strategies, then it would have been a little bit better than just arriving at retirement with $2 million in pre tax.
Yeah. And I mean, at the end of the day, like I said, if you're somebody out there who is already retired and you're like, oh man, well, I wish I'd done that ahead of time. It's not too late to still improve things. And it's not like you should just say, well, I'm retired, I can't do anything anymore. I have what I have. But there are just certain levers that you can't pull anymore once you're retired, that are just gone.
They aren't available.
Yeah, they're just unavailable at that point. And if you didn't do it ahead of time, you're just not going to be able to do it. It really just comes down to being reactive versus being proactive. And I think a lot of times people, I think waiting until you're a month away from retiring to go talk to someone about retirement is more reactive than it is proactive. It's, oh, well, I'm going to retire in a month, so I really need to, it's waiting until you have, some weird health problems to go to the doctor and you haven't got your annual physical in 20 years. It's like, you really should have been getting your physical along the way. And, that, not saying when you get sick, you still shouldn't go, but I just think we have a tendency as people to think, okay, well, I'm saving, I'm putting money away, my net worth is growing, the market's going up, I can just wait and I'll just figure this out later. rather than, okay, yeah, all those things are going well. And that's great. That's like the most important thing. If you're saving money, being proactive about putting money away, being proactive about retirement, that's great. But you also have to think about, am I doing this in the best way that I can? Are there better ways that I can be doing it? I think, especially with people in their 40s and 50s, just poor cash flow management is leaving so much money on the table. And even people in their mid to late 50s or early 60s that are still working, because those folks are at their peak earning years. They got so much income coming in that they don't even really know what to do with all of it sometimes. And a lot of folks just say, oh, well, I got more income than I got expenses, so I must be doing pretty good. It's like,
Yeah.
you are doing pretty good, but you could be doing better.
Right. What about family that comes in and says, well, we're going to call you back when we retire?
Yeah.
Like, whoa, I mean, too late
It
for
might
some
be
things.
a little late. Yeah.
It may not be too late to, it's like never too late to go back to college or whatever. But, in that case, it's like, okay, well, what if you came to us 5 years and you didn't want to work with us at the time and you were like, hey, we're just going to call you back when we retire. But during that 5 years, you could have been doing some things to prep yourself long term in retirement. And I think that's the thing that's missed by a lot of people, but just not proactively planning and designing your retirement and rather drifting into it. So anyway, I think we beat that one good enough. Planning is important is the
Yes.
message here. So wives, if you're listening to the show and your husband is, you don't know if he's planning, elbow him right now and say, hey, what are you doing about your taxes and how are we going to navigate the IRMA? And are we doing an HSA? And do you understand what an HSA? Because, we beat the HSA drum to death on the show, but I've had so many people tell me, they said, man, I wish I would have done that, 20 years ago. It's the same thing with like the Roth. I wish I'd have known 20 years ago I should have put more into Roth, but we don't take action on the things that we don't understand. And that's what we're here for. That's why we do the show, is to educate and put stuff out there so people can kind of understand what their options are.
Yeah, one more question for the wives to ask. Just, if you're in the car driving and you're wondering, just ask your husband, what is your Roth conversion plan post retirement?
Yeah.
And hey, if he's got one, then give him a kiss, make him a nice steak tonight. That's awesome. Good for him. But I would say for most people, when it comes down to the question of what's your retirement plan, their answer is going to be more aligned with, I'm going to retire at this age and I hope to have this much money. And it goes no deeper.
It's
than
all
that.
based on a number.
Yeah.
Which to me is like, that's only a small part of it. I mean, you got to have the numbers at the end of the day, but you got to have a plan for all of the things in retirement. And I think that's where a lot of people miss the boat. And just really, they rely solely on that number, that some of their other areas of their plan is inefficient. And that's when we do our report card for people that come in, is it kind of highlights some of those things. And I don't know how I don't sit in all your meetings, Graham, because you run your own meetings, but I have never had an all green report card ever.
No. Yeah.
You?
I can't remember one.
Yeah, same. I mean, it's like there's always opportunity for improvement. And that's what our aim is, to take a family. I told somebody the other day that you want to get your financial planning to the next level, come see us, because that's what we do. We just try to take you and your family to the next level. Make sure you and your family are protected as possible from an estate and legacy standpoint. Make sure you're tax efficient as possible. Make sure your investments are set up appropriately. Make sure you got the right income. I mean, our report card looks at all of that, and it's heavily in the tax efficiency area. We put a heavy focus in there because that's where most people we find are just inefficient.
All right. So I want to make sure that you have this phone number. If you want to nudge your husband and ask him these questions, and maybe
put him in the headlock.
Yeah. If he doesn't answer correctly, then we want you guys to give Chris and Graham a call. So our phone number is 256-937-2010. You can call the number. You can also text if you like texting better. Just text the word visit to that same number and get on their calendar. It's a discovery session, complimentary. So take advantage of this. We're talking, declaring financial independence, okay, in retirement. Now, guys, I want to talk about timing. And, I know, Chris, and Graham, you guys have told the story, about two different people who retire at different times. Okay. So, and then just the difference that it can make. Someone who maybe is considering retiring in 26 or 27. Okay. Number of factors to take into consideration: pay raises, inflation, market volatility, and then policy shifts. So each one of those can make a huge difference. And tell us why the year someone retires matters so much financially.
Well, obviously, Graham kind of mentioned this a few minutes ago. A lot of people that are in their latter 50s and also maybe their early 60s, they're in their peak earning years. So they're making the most money that they've ever made in their entire life. And working a little bit longer can raise the pension. I know with the federal government, if you can get to 62, you get that extra point 0.1, which is kind of nice. It really raises your pension, pretty good little chunk there. So it really matters on when to retire. I talked with someone yesterday. They were in the office and we were meeting, and he had done some calculations and basically was using the what I would call the 4% rule. And I kind of told him that. I said, I think you're kind of using the 4% rule. And he says, no, I'm not actually using the 4% rule, but it's kind of close, but it's a little bit more. And I was like, you realize you're like 59 years old and you're using a 4.5% withdrawal rate. And what if we have a recession in the first year that you retire? So you've got to really pay attention to your diversification, the market volatility, which you can't control, but you can control how your portfolio behaves during certain market conditions. And oh, by the way, with you retiring at 60, you can't even take Social Security, even though you're a federal employee, you're going to get a supplement. You can't even take full Social Security or you can't even take your Social Security until 62. And I don't think you should. I think you should wait to 67 because your wife's Social Security is so much less. I think it's better for y'all, both of you together, if you wait a little bit. And so since you've got a full income, we now have to worry about sequence risk. And also, when you retire, we're going to be coming up on election year here in a couple of years. And that, to me, that's a little bothersome because I just feel like if another party gets in office, they're going to attack the tax code. I just think that. I don't know that. It's just my personal opinion because everything that the current administration has done today, if another party gets in office, they're going to say, well, I don't like anything that person did and that administration did, and we're going to undo it. And we're going to try to pass things through. And that might mean changing the tax code. And I can tell you, because I do the numbers, I look at the numbers, the tax code today is good for everybody. I mean, is it no tax on everything? No, it's not. That would be wonderful. But in reality, the taxes are pretty low today. And that does scare me that if another congressional party gets in, because changing the tax code like that does take congressional approval, but it does scare me a little bit. It's like, oh man, are our taxes going to go up? And, I worry about taxing corporations that provide people jobs and things like that bother me. You have to worry about that kind of stuff when you go to retire because there are, like you mentioned, policy shifts. That's one, as I was kind of alluding to there, and you just don't know. So I think when you get to retirement, you've got to talk about how to play defense as well as offense. So you definitely do not want to be in a position where you're not growing your money in retirement. I definitely think that's a bad idea. And I think that's honestly, early in my career, I can say that I mentally fell in the camp of you can't lose money in retirement. And the firm that I originally started with years and years and years ago, their mentality was active management, don't lose money in retirement. And as I grew in the industry and started to build experience and building out financial plans, I quickly learned that it is okay to lose money in retirement. It's not okay to lose a lot of money for most people. And I think that's really the key difference in where my head is at today and how we work with clients is, hey, you're going to lose a little bit of money because you're invested. But what we want to do is position your assets to continue growing in retirement because we've got this ugly thing called inflation that ran kind of wild here in the 2022-23 timeframe. And it sort of got calmed down, but never brought all the way down. And now it's peaking back up again. So guess what? We need our investments to outpace that because the cost of goods and services is going up and the value of the dollar continues to drop. So we need the value of our portfolios to go up to offset some of that. So there's a lot of things that you got to think about as you start building out that financial plan and the timing of retirement. And I'll say this as I kind of wrap this up. The number one fear to today's retiree when you poll a bunch of people is running out of money. And I've said this before, and Graham, I know you and I have talked about this before. If you know you're running out of money and you're looking at your account and you see your account balances drop, probably you're going to curb some of your spending. Maybe you don't go out to eat and buy, 3 meals out in a week, eating out if you eat out that much, or maybe you're taking 3 trips a year in retirement, but now all of a sudden the accounts are dropping and you're like, oh man, honey, maybe we shouldn't go on that second or third trip. Maybe just do the one smaller family beach trip and not the big cruise in Europe. So you can kind of curb your spending is kind of my point here. And I don't think that most people are going to run out of money, even though I think advisors today really try to promote that fear is A, you can't lose money, and B, you don't want to run out of money. And I think the worst thing that can happen to somebody is losing a lot of money in the first couple of years of retirement. That can be detrimental. And that then can trigger you to where you may run out of money, or you may not be able to enjoy the first part of your retirement, which for most people is going to be the most active time of your retirement. And really, when you're probably most likely to spend the most amount of money is in the first part of your retirement. So I think the worst thing that can happen to somebody is losing a lot of money in retirement. And that is why at our office, we prefer that we protect like the first 10 years of your retirement so that you don't have to worry about pulling from depressed assets and selling stock that's down. Let's build a sustainable, guaranteed income stream for like the first 7 to 10 years of your retirement. So we don't have to worry about that big downfall, and we can increase our investment time horizon and still grow our money like we want to. So that to me is the biggest thing about planning, Luann, is really protecting yourself from that big loss early on.
You mentioned inflation. Okay. So it's still a serious threat, even if someone has significant assets, right?
Yeah, the inflation threat never goes away. Because when you're thinking about inflation, you're thinking about your spending generally, because inflation is going to mostly affect, for a retiree, it's going to affect the cost of goods that you have to buy to sustain yourself. And for the majority of retirees, they're on, a relatively fixed income. You have Social Security, which gets an inflation adjustment, but it doesn't always necessarily keep up with the real inflation. I think if you ask anyone who's on Social Security over the last 5 years, hey, do you feel like your spending power has stayed exactly the same as it was 5 years ago? They would say no. And that's going to just put a little more pressure on people's portfolios over time. So I think when you're talking about the inflation risk, we'll run plans sometimes and they'll struggle a little bit, even though someone has a good amount of money saved. And what it usually comes down to is the fact that over time, if they start out their retirement at a higher level of spending and they only have maybe Social Security as their only fixed guaranteed income source, that over time, as inflation starts to eat into that Social Security, they have to pull more and more and more out of their portfolio, which can just lead to higher withdrawal rates and a little bit more risk long term. So when we're making plans, we're not running anything crazy as far as saying, oh, there's going to be 8% inflation every year forever, because nobody's going to be able to retire if that's the case.
Right.
But what you do need to look at is, if inflation stays a little bit elevated, am I going to be able to kind of eat that cost? Because there's two sides to it. The one side that the costs of a lot of goods just are going to increase over time. And also your spending might just generally trickle down a little bit as you get older. So I don't think that if you're worried about inflation, you have to put all of your money in the stock market and spend absolutely no money in retirement and be all scared of it. But I think you do need to know that, okay, if my budget is going to, increase by 3% a year, 2.5% a year for the next 30 years, and Social Security maybe doesn't keep up with that in COLAs, do I have enough saved in other assets to have that eat into the inflation that's increasing my expenses? So that is something that we look at. I think inflation has generally maybe become a slightly less of a concern for some people. I think it still needs to be a concern, but in the whole 2022, 2023 era, people were very, very concerned that that was going to keep up. And I mean, we didn't believe that 7, 8% was going to keep up year over year, but that's still a lot of price increase in a short amount of time that we're still feeling today. So when these things happen, generally an inflationary period like that is a permanent increase in prices. And you may run into a situation where you retire and 3 years later, 4 years later, the cost of goods are a lot higher than they were when you retired. So I think it just comes down to building a little fluff in your budget and making sure that if 20 years down the road, inflation has really eaten into my fixed income, am I going to have enough assets? Am I going to invest in the proper way that I can kind of absorb that with my portfolio, with savings, whatever that looks like?
Yeah, and I think that's talking about inflation. That's why it's important that people save. Because I'm a firm believer that money doesn't buy happiness, but it buys convenience. And people that have saved a lot more money will have a little bit more, kind of to your point, a little bit on there about the buffer. They'll have a little bit more buffer in the way of offsetting or at least fighting inflation to some degree. But you got to grow your money, and it can't be sitting in our opinion, it can't all be in conservative assets. because you're just not going to grow your money to outpace inflation. And I think that money doesn't buy happiness, but it buys convenience. So if you're prepping for retirement, make sure you're saving. I'm always a big fan of oversaving to a certain degree, because if I oversave and I'm still able to do things with my family and find that balance, if I've oversaved, I might be able to retire a year or two earlier if I want to. So I'd rather be in that position to be in the opposite position of I'm just trying to get to quote unquote that number so that I can feel able to give myself permission to be able to retire. I'd rather be oversaving at that point to create a little bit buffer there for sure.
All right. So, with all of this, tell us what separates someone who has simply accumulated wealth from someone who truly has declared financial independence, someone who can retire with genuine confidence.
We kind of touched on this a little bit earlier. You can have all the money in the world, and if you can't give yourself permission to spend, or you can't give yourself permission to freely go about your day without worrying about your assets all the time, then you're not what I would call financially. You don't have true financial independence. True financial independence is, in our opinion, having a plan in place, having an income strategy where you know where your money's coming from, not just looking at a balance sheet with balances on there, because too many people look at a number. Well, what's the number I need to retire? Well, it's different for everybody. Spoiler alert. When you're truly financially independent, you know exactly what you own, why you own it, and how it pays you in terms of your investments. And your decisions are driven by your plan. Like, I can't tell you how many times we get asked, well, how much do you charge? And I'm like, well, how much are you paying? And this is what I hear. They don't know. And the reality is, when it comes to working with a firm like ours, we tell people, listen, when you go to buy a car, like, call us. Let's just talk about it. You go to buy another house. Let's talk about it. Use us as a sounding board. You're not only just paying our firm to manage assets, but you're paying us to help you build and develop and carry out a financial and retirement plan. So your decisions in retirement, if you're truly financially independent, are driven also by, your plan. And every piece of your financial life should be coordinated with clear purpose. So I think that is, when you become truly financially independent, is you're not worrying, you're not checking your account every day. You know how your money's allocated, you know what the purpose of it is, you know how much you're paying in expense ratios, you know how much you're paying your advisor. If you're listening to the show, I'm just going to tell you right now, if you're listening to your show, elbow your husband again. If he's near you, just elbow him again. How much are we paying our advisor? Because most of the time people don't know. They truly don't know. And if you don't know, then you have to start asking yourself, okay, what kind of value am I getting? Am I getting help in the areas of Medicare? Am I having conversations about tax efficient strategies? Are we talking about our estate and legacy options? Are we talking about how to protect our kids and our grandkids? Do we know all of the ways that are allowed today within the tax code to utilize vehicles that are out there today to be able to pass on wealth to kids and grandkids? And no, for you guys listening, I'm not talking about life insurance. There are other things that you can do to help transition wealth over to your kids and grandkids. And we cover all that because that's what we do. We build things off a plan first. And then we're not so reactionary, because I think when you're working off a number and you're just trying to get to the retirement quote unquote number, then you become very reactionary instead of being proactive. And that's kind of what we do at the office. If you want to sit down with us, give us a call, 256-937-2010. Again, the number is 256-937-2010. I hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
Please remember, converting an employer plan account to a Roth IRA is a taxable event. An increase in taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Graham Bauer holds the enrolled agent designation, but is not currently offering tax preparation services. Neither the firm nor its agents may give tax advice. Individuals should consult with a qualified professional for guidance before making any purchasing decisions.
Investment advisory services made available through AE Wealth Management LLC, AEWM. AEWM and WG Financial Group are not affiliated companies. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Financial Group are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only and is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. WG Financial is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial. This radio show is a paid placement.